Hi guys, here's Hustle Hub. Today we're going to talk about ESG. Environmental, Social and Governance, or ESG, is a set of criteria to determine the overall sustainability of a company. These metrics help investors to understand if a company's business practices are environment-friendly, if the workforce is guaranteed safe working conditions, and if the governance is sufficiently diverse and reliable. Since shareholders' rights are also considered ESG ratings, this type of investing is often called sustainable investing, responsible investing, socially responsible investing, and so on. In recent years, investors have slowly changed their philosophy. Now, in order to decide whether to invest in a company, they consider both the financial statements and the company's environmental and social impact. As a result, many financial companies have come up with financial instruments that invest in companies with good ESG ratings, for example ETFs, exposed to ESG-compliant companies. So let's break down what makes the ESG rating of company. First, we must take a look at the environmental issues. The use of energy, natural resources, treatment of waste, treatment of animals and pollution are all taken into account. Various risks are also considered as well, like whether the company adopts safe processes and whether it complies with regulations. This is particularly important to limit the risk of fines and lawsuits from regulators. Social criteria look into the company's relationships, especially with suppliers, employees, and the surrounding community. If the company selects suppliers that have good values, that respect the environment and their employees, the company will receive a positive ESG rating. If the company has safe working environments, treats employees well and incentivizes them to take part into volunteer activity, it will also have a good outcome on the ESG rating. On the governance side, ESG metrics value shareholders' rights to have a say in key decisions, transparency of accounting methods, and the manager's absence of conflict of interests. Of course, very few companies reach high scores in every single aspect, but the rating helps retail and institutional investors decide what's more important for them. Given the fact that some of these ESG funds performed very well in the last few years, it is clear that it is not just a matter of ethical principles. London Business School's Henry Service showed how the 100 best companies to work for in America strongly outperformed the S&P 500 between 1984 and 2009. This is not a coincidence. The best companies to work for attract and retain top talents, allowing them to outperform competitors. In the case of companies focusing on environmental sustainability, their performances compared to the benchmark can be interpreted in different ways. Some say that having a well-defined long-term environmental policy, these companies have an advantage compared to those that make year-by-year decisions. Others believe that environment-friendly policies and processes are intangible assets. Since the market doesn't take them into consideration, the company might be undervalued and have a high potential. Others claim that the outperformance is just a consequence of the higher influx of capital that ESG-compliant companies have, compared to their non-compliant competitors. In the end, some see the ESG movement as a hoax or as a marketing trick for companies. One of these is Chamath Palihapitiya. One thing that is clear is that there is not a standardized way to track companies' improvements from an ESG perspective yet, so it is not clear if companies are actually keeping up with their promises. Lately, a new investment theory has come up. Companies that are not ESG compliant have better value investing opportunities than ESG compliant companies. Given the fact that they are denied investing capital, they have lower PE ratios and higher dividends. On the flip side, ESG companies can raise capital at lower rates to reinvest into the businesses as a result of the higher influx of capital. So it is not clear yet how it will all play out in the future. Another plus of companies with a high ESG rating is their better chance to avoid sudden or significant losses. Let's make a few examples. Both Equifax and Facebook didn't meet ESG requirements because of poor privacy policies and data protection. So when the data breach in the case of Equifax and the Russiagate in the case of Facebook occurred, ESG investors weren't exposed. Many similar situations in different sectors can be found in events such as the various oil spills from oil extracting companies and the so-called Volkswagen Dieselgate that resulted in significant drops in the company's stocks. ESG ratings aren't standardized yet. Every institutional investor and database has its own metrics. From Bloomberg and Thomson Reuters to BlackRock, Fidelity, Vanguard, and so on. Thank you guys for watching the video, and remember to give us all your support by subscribing to the channel, smashing the like button and turning on the notification bell. See you next time with another video for you. This is Hustle Hub.